Assalamu alaikum friends, welcome to part 4 of changes in group structure. In the previous 3 parts, we didn't cover the overseas subsidiaries, where the subsidiaries and the parents are having different currencies, right? But in this part 4, we'll be dealing with the overseas subsidiaries where the parent, the group's currency is different and the subsidiary overseas, the currency is different. So how to deal with that? How do you consolidate that? That aspect we are going to cover in this video. And this is also new for SBR because this part was not covered in your financial reporting, the overseas subsidiary. But trust me that this is the easiest. Okay, it's just that you need to know how to translate and which rates to translate the subsidiaries financial statements, and then you consolidate in the normal way how you normally used to consolidate for the local subsidiaries and all. So let's start. And this is the last video also on group accounting. After this, I'm not going to do any more videos on group accounting because I've completed group accounting. So let's start. Group accounting, before you consolidate, remember the subsidiaries currencies are different to the groups. They have to have the same currency as the group. That's why we first have to translate their assets, their liabilities, their income, their expenses, and then you have to consolidate. So how do you consolidate? For assets and liability, you have to use closing rate. That means whatever the figures are there in the statement of financial position figure, they are translated using closing rate. Okay, these rates will be given to you in the exam. So assets and liabilities, closing rate, you have to remember. Okay, and when it's income, expenses and OCI, all the statement of profit and loss and other comprehensive incomes items will be translated at average rate. Okay, then coming to goodwill. So first you have to calculate in the subsidiaries currency. Remember, when you calculate goodwill, it has to be calculated in the subsidiaries currency. It could be different to the parents. And then you have to translate at the closing rate. Why closing rate? Because goodwill is an asset, no? This goes in the statement of financial position normally. So all the assets here, if you see, translated at the closing rate. So even goodwill will be translated at the closing rate. Now, what about the exchange differences and all? You'll be having some differences, okay? Some gain and losses because of the translation. And this gain and losses due to exchange translation can come from 3 places. One is goodwill, second is net asset, third is profit. Goodwill, why? Because goodwill, every year you have to revalue your goodwill. That means every year you have to translate goodwill. So every year your closing rate differs. That means there will be some gain and losses. Opening net asset is also like that. Every year when you are finding the net asset, when you have to translate the net asset at the year end, the rate changes, closing rate. Every year the closing rate is different. And same for the profit. Average rate you are using for the profit, that also every year the profit is different. The average profit changes. That's the reason. For the profit is not about the changes in the average and in the profit. The reason why is because some items, to calculate that profit, some items are translated using the closing rate. Some are translated as a closing rate. One example, let us go to the profit. Okay. For example, income and expenses you translate at the average rate, right? But in making that profit, whatever the asset is there, the subsidiaries asset, that you translate at the closing rate. For example, depreciation of non-current assets. That non-current assets of subsidiary you translate at closing rate, but the depreciation you translate at average rate. So there is a disparity between that two. So that's why it creates an exchange gain on loss. Opening net assets and goodwill is not like that. Opening net assets and goodwill, the difference comes because of the movement in the exchange rate. Okay, because every year you have to retranslate them at the closing rate. That's the difference. Profit is not like that. Profit, because there are disparity between the two. But ultimately all the three will give you an exchange gain on loss, and you have to know the pro forma. There's a pro forma. One is for goodwill and the other one is for net opening net assets and profit. These are together. There's a pro forma that you need to learn. Okay, let us first finish. Okay, and that's why it's given together, opening net assets and profit and goodwill. So if in your exam the question asks calculate the exchange differences. You first have to know the pro forma of goodwill and opening net assets and profit, because the exchange differences comes from these three places. And whatever the gain and losses, the gain and the losses are recorded in OCI. Whatever that exchange gain and losses takes place, that will be recorded in OCI and held within equity in the statement of financial position. Now the last part of this that you need to know, when you're disposing that overseas subsidiary, what happens? That gain and loss, that accumulated gain and loss that you have recognized in OCI will now be reclassed, recycled to profit and loss, reclassified to profit and loss when you are disposing that overseas subsidiary. That foreign exchange gain and loss, okay? That which is in OCI, okay, here you are recording in OCI. So it will be now reclassified to P&L when you are disposing that overseas subsidiary. So that's it. We are over. That's it you need to know about foreign subsidiary in group accounting. Another thing is the pro forma. Let us just go through the pro forma and then we can do the questions. So the pro forma, this is for the goodwill, okay? Goodwill pro forma, you have to have this columns, okay? This will be in your foreign currency and this will be, you will be converting it into dollar. Let's say this is the parents or the group's currency, okay? Whatever is on the right side is the group's currency. You have to translate it at that, okay? So first you will be having opening goodwill in this currency. You start with the foreign currency, so the subsidiaries currency, opening goodwill. After that, if you have any impairment, there could be impairment, there could not be an impairment, but usually they give an impairment because opening goodwill is at opening rate, impairment is at average rate. That's why they will give you an impairment. So you deduct that impairment, nothing goes here, and then the closing goodwill. Now you come to the dollar, you convert this opening goodwill in the opening rate because it's opening goodwill, no? I told you do closing rate, but this is the pro forma you need to know when you are using goodwill. Opening goodwill, opening rate. Closing goodwill, closing rate. Impairment, you'll be using average rate to translate. And hence you'll be writing this in dollars, okay? After translating. There'll be three columns. One is for this currency, second is the rate, and third is the after you have converted it into the group currency. Then closing rate using the closing, okay? Closing rate. So all this and this are filled out. What is left is this. That is the balancing figure. That balancing figure is the exchange gain or loss. Okay? Why? Because when you deduct this impairment from the opening goodwill, the balance is something else. And when you convert this closing goodwill at this closing rate, the balance here is something else. So there's a difference between these two. That is the balancing figure. Okay? That balancing figure is the exchange gain or loss. What happens when you buy the subsidiary part away? Because they told opening rate or closing rate or average rate. What about when it's part way? When you bought it? Then you have to translate at the rate of exchange on the acquisition date. For example, for the goodwill, right? Opening goodwill, we use opening rate. So you have to say at which date you have bought that subsidiary. At that rate only you will be using for the subsidiary goodwill also to translate the goodwill, opening goodwill. Okay, you will be using the date at which the transaction happened, the acquisition happened, and that rate only you will use to translate the opening goodwill. Now it is important to pay attention to this, the methods of goodwill that you have used. Why? If it's a full goodwill method, remember that foreign gain and losses, the translation that happened, and because of that the gain and losses that occurred will be divided between the group and NCI if it is the full goodwill method. That means fair value of NCI. If it is the second method, proportionate goodwill, then the exchange gain or loss will only be going to the group relating to goodwill only. Okay, the same thing is repeated for net assets and profit. This pro forma is there for net assets and profit as well here. So I don't have to repeat, it's the same, it's just a repetition of that. The only change is this is net assets and profit here. Okay, and for net asset it is the opening rate, and for the profit it is the average rate. That's it. That's the only difference. And here also, if it has happened past part way, the subsidiary, then you have to use not the opening rate, the rate at the date of acquisition, whatever the rate is. If they don't give you any rate for the date of acquisition, then the opening date only. Even if it's part way, you have to use the opening date. Okay. So here also that gain or loss will go, net assets and profit will go to the NCI and the group. Same way how we have done for goodwill, but goodwill and net assets and profit are separate. Okay. And in the statement of financial position, there's a separate reserve known as translation reserve. That will go. It is a separate component within the equity. Okay. This exchange losses, gain and losses will go there from the translation of goodwill as well as the net assets and profit. All these three things, whatever the gain and losses due to these three things will go there. Okay. And then disposal, we know that it will be reclassified to profit and loss account. Just another thing. So let me see whether I've covered everything. Yes, everything is covered. Now let us start with the question. So illustration 1. Let us read the requirements. For inclusion in the consolidated statement of profit and loss and other comprehensive income, you have to calculate the revenue and the cost. And statement of financial position, you have to calculate PPP, investment current assets, share capital, liabilities. Okay. So if you go here and look at the answer, all of these 5 things you have to calculate, they told you. Okay. For the parent, you can take as it is because it was in dollar, if you see. Share capital, but when you take the share capital, it is only the parent, the dragon only. Okay. 10 million, because all these are in million. Make sure that you write the currency. Currency is very important. Whether it is a foreign subsidiary or not, you still have to write the currency. Okay. 10. So everything else, and here only you are taking, when you are taking the subsidiary, you are just converting it, right? And investments, remember there will be no investments. This will be eliminated on consolidation. Okay. So the only thing which I'm going to tell you here is what rates that you have to use. That's it. Okay. Answers you can automatically find out. So if you see here, so they bought 90%, that means it's a subsidiary for 180, and the retained earnings is 65. All these are in different currency, and the fair value is also 14. And if you see the currencies are different. Okay. Subsidiaries currencies and all. And this investment on the consolidation, it will be eliminated. No investment. And there is no intra-group trading. Goodwill is also not impaired. Presentation currency is dollar. Okay, you have to always see the presentation currency of the consolidated financial statements or the group. So you have been given the 3 rates. This is the opening rate, this is the closing rate, opening OC, and this is the average rate A. 3 to 2.6. Okay. Now, when it comes to revenue, just okay, let me write 3 to 2.6. I will write here 3 opening 2 C and 2.6 average. So tell me which rate you have to use for revenue and cost. It is 2.6, both for revenue and for the cost. You have to divide it by 2.6 to get it in dollar. Divide by 2.6. 600 divided by 2.6 and 450. All cost, income and cost will be average rate 2.6. If you see here, you see 2.6. And all the statement of financial position, PPA, this is closing rate 2. Current assets 2. Liabilities 2. But share capital only the parent 10. And this is eliminated. So isn't it very simple, guys? You see, only 10. This is very, very simple. Now let us go to illustration 2. You have to use the same information from illustration 1, but here you have to calculate goodwill, because earlier we didn't calculate goodwill. That is the normal thing. That is just for the simplicity and for your understanding, the basics. That's why they didn't include goodwill there. But you have to calculate goodwill because it's a subsidiary. So how do you calculate goodwill? You have to calculate in this currency, not in dollar. Later you have to convert into dollar. So consideration, it was at 180. NCI is also given. Net asset, there's a working. and goodwill has not been impaired, so this is dash, and 124. But before that, let us first go and find out the net asset, 70. To find that net asset, this is the working that you have to do, and all are in DN, nothing is in dollar. So share capital as it is, you can take retained earnings, and this is reporting date. This reporting date means you have to take from the statement of financial position. Okay, that's why the share capital will be same 55, only this will increase, and hence that increase of retained earnings is the post acquisition 150, right? You have to keep it, you need it later on, but you are taking the net asset as the date of acquisition for your goodwill purpose. Okay, 70, hence you are deducting 70, and 124, this 124 you have to deduct it by 2 because 2 is the closing date. This is the repetition from your illustration 1 only, okay, not a new question. Hence it is 62. Okay, so that's it. You have to put that 26. Now let us go to illustration 3. Again you have to use the illustration 1 only. Calculate the exchange gain or loss when you are translating that goodwill. Okay, that will be charged through other comprehensive income. Who is this gain or loss attributable to? So you have to follow the pro forma now. Pro forma of goodwill. So opening goodwill is 124. This you have calculated it. This you will be translating using the opening rate, hence 41.3. Impairment, there is no impairment. Still they have writing the date, but it's okay. If you want, you can just write a dash for this because you are not using the impairment. There's no impairment here. So closing goodwill will be the same as opening goodwill, and this opening closing you will be dividing it by 2. Hence this 62. Okay, but when you're taking this 41.3, you see this is 41.3, but this is 62. There's a difference between this two. That difference is the exchange gain, because if you see the opening goodwill, it increased to 62. So goodwill increase means it's a gain, exchange gain 20.7. Okay, and this 20.7 will go to OCI, other comprehensive income, and they told how much it will be allocated. It will be allocated 90% to the group and the 10% to NCI. Okay, of this 20.7. Now illustration 4, we are still using the illustration 1 only. You have to calculate gain or loss on the translation of opening net assets and profit. Opening net assets and profit are taken together only, they are not separate. Only goodwill is separate. Okay, so this is also same question repetition. Gain and losses will go to whom? So same pro forma you have to follow, except that this is opening net assets and profit, not goodwill and impairment. Okay, and this is also you have to take in their currency first. Okay, you make sure that in your exam also you have this 3 column, 4 column actually. This is for description, this is for subsidiaries currency, this is the rate that you are using, and this is the dollar. Don't just immediately put this answer only. You have to show this working. This table has to be there, and better to use Excel for this in your CB platform. So opening and profit are given, and opening will be using opening rate, profit average rate, closing rate. So this, if you add this 2 and see 23.3 plus 57.7, it will not add up to 110. There's a difference. It will be less than 110. So that means closing net asset increased. That's why it's a gain here. Gain will be without bracket. If it's a loss, you have to put bracket. Okay, don't forget that. So here, since it is 29, same 90% will go to group, 10% will go to NCI. Okay, now let us go to illustration 5. Same using illustration 1. Calculate NCI, retained earnings, translation reserve. Okay, so when you're calculating NCI, you start with the date of acquisition. NCI was given to you in DN 14. You have to use which rate? Opening rate. They have already given you that opening rate. NCI at acquisition, that's why you are using opening rate. Okay, so 14 divided by 3. Now you have to take the post acquisition profit, NCI's percentage. NCI was 10%. Post acquisition profit was 150. You have to take average rate because profit. If you see here, 150 for net assets and all. Wait, I don't know which illustration was that. Yes, it was illustration 2. You see, 150. You need this now. for NCI purpose. You have to take the percentage of this 150. Hence, we are taking 150. Now, after you divide it, you are taking 10%. Okay, 150 divided by 2.6 and then you are taking 10%. But if you multiply and then divide also, there will be no issue. Okay, it's the same thing. But if, finally, you will be getting in dollar the answer. And now, remember, it's a fair value goodwill method. So you have to take the NCA percentage of goodwill translation as well as the net asset and profit translation, the foreign gain and loss. This time it's a gain. So goodwill illustration 3 we have calculated, and net asset and profit also it was calculated. Now you only have to take the 10% of it. That's it. Okay, if you want to see here, you see 29 for net asset. So if you take 10%, it will be 2.9, and 21 for goodwill, 10%, 2.1. You have to add, and 15.4. Now coming to the retained earnings. Retained earnings, you have to take 100% of the parent and 90% of the subsidiaries post acquisition profit. That means from this 150, you have to first divide it by 2.6, the average rate, and then take 90%. Coming to translation reserve. Translation reserve, only two things will go. One is the goodwill, one is net asset and profit. But only the group's share, remember, not the NCI share. Okay, because NCI share already went here, this too. So you don't have, there is no logic to take it again here, right? It's a repetition. So only the group share will go there in the translation reserve. Now, let us go to illustration 6. They just told for the inclusion, okay? They didn't tell you to make a full financial statements. But in this case, they told to complete the consolidated statement of financial position and the statement of profit and loss and other comprehensive income. In the exam, they will not ask you this type of questions. This is very easy. This is just for your understanding and learning, practicing. So if you see, it is already calculated. Revenue minus cost and the profit. Once you find the profit, we have other comprehensive income. Remember, in the other comprehensive income only we are putting the exchange differences. Okay, this is, one is relating to the goodwill, the other one is relating to the net assets and the profit, and it's a gain. That's why it's a positive sign. Okay, and when you're writing other comprehensive income, another thing you need to write is whether it will be reclassified or not. So items that may be classified to profit and loss in future period, you need to write this. Items that may or may not be classified. So this will be classified. So you have to write. If something is not classified to profit and loss, you cannot classify. That also you have to write. Items that may not be classified to profit or loss in future period. But you need to write when it is under other comprehensive income. Okay. When it is under profit, no need to write that. Items are reclassified and all. Then we are having the total comprehensive income. After that, what is it? Profit that will go to the owners and the NCI. Total comprehensive income that will go to the owners and the NCI. So if it's for the profit, you are taking this 257.7. Okay, if you see here 257.7, this you have to take out. So for the NCI, see, owners is always the balancing figure, whether it is for total comprehensive income or the profit. You just have to work out the NCI part. This. So NCI you have to take 10% of what? Post acquisition profit into 2.6. Post acquisition profit only you have to take. Okay, this is profit, that's it, not the total NCI. So DN 150 divided by the average rate, and here when it comes to total comprehensive income, what are you doing? 5.8 is the profit plus 2.1 plus 2.9. This 2.1 is relating to goodwill, this 2.9 was relating to the net assets and the profit, translation of the foreign translation gain, and this 5.8 is the profit. Okay, where did we get this 5.8 from? Okay, because if you'd see here, we are taking 10% here of 150 divided by 2.6, because this was This post acquisition profit, it was a profit that was in DN. That's why we had to take the average rate. But when we come to the total comprehensive income, it was already given in dollar 5.8. We'll see. We have to see the illustration one for that. Okay, here they didn't give you anything for this thing, right? They didn't give you the total comprehensive income 5.8. It is this, sorry, this profit only that you have to take. So it's the same. Okay, after that you are adding this 2.1 and 2.9. That's it. Profit you are taking, but remember you took this and this. You have to take 10% of this too for total comprehensive income with the profit for NCI, and hence you will get the total comprehensive income for the year. Now let us go to the statement of financial position. So property, plant and equipment, we already worked it out. Goodwill also, current assets also. Okay, you add the parent plus the subsidiaries. So share capital, return earnings, translation reserve, all this we have worked out. Share capital only the parent. NCI also we finished. Liabilities also we finished. All this we have worked out previously. Now we are just putting it and we are trying to balance. Okay. So let's see whether it balances or not. Yes, it balances 702, 702. But in your exam, you will not get a question like this where you have to balance it on. You will be just asked to discuss, or you may just have to prepare extracts. Now let us go to test your understanding 1. The 3 test your understanding. So parent is an entity that owns 80% of equity shares of overseas, a foreign entity that has the shilling as its foreign functional currency. This subsidiary was acquired when its retained earnings was 6,000 shillings. Reporting date is 31st December 2007. Fair value was equal to the carrying amount. Fair value of the net asset was equal to the carrying amount with the exception of the freehold land. So the fair value of this land exceeded its carrying amount by 4,000 shillings. At the date of acquisition, NCI is 5,000 shilling. Goodwill is not impaired. Okay. Now you have been given the statement of financial position. The rates you have been given. Okay. Opening, closing and average. Now discuss how the goodwill should be dealt. Very common question in the exam. If you have done the revision kit questions relating to goodwill for overseas subsidiary, you know how to calculate goodwill. This is nothing for you. So when you are calculating goodwill, this is just for the goodwill they asked. They didn't ask you a full consolidation. So you have to calculate in shillings. Okay. When you're calculating it in shillings, so here they didn't give you what you yes, I was looking for that, even though they didn't write it in the sentences, but here they have wrote it that you have bought the investment in overseas at cost. Okay, this is in the individual financial statements is given for the parent, and it was in dollar. So you have to convert this dollar into shillings. Even if it's given in the currency that you want to translate at the end, remember you have to translate it to shillings first, and then again later you have to translate to dollar again, because goodwill always in the overseas functional currency only, that is shillings. So when you see here initially it is calculated in the foreign currency, so 3818 into 5.5, multiply it now. Which rate you are using here? 5.5, the opening date. Because for calculating the opening goodwill, opening 5.5. Now fair value of NCI is already given, add, and net assets you have to find out. Okay, so net assets you have to add the share capital, retained earnings, and fair value adjustments. They told it will exceed by 4 billion, 4,000 the value of the land, so add that, and then this will be your goodwill at acquisition. There is no impairment, right? So because this is a foreign currency asset, this is the subsidiary's asset for you, you have to translate it using closing rate. This now you have to convert it back, closing rate. What is the closing rate? It is 5. Okay, so you have to divide it by 5, and hence this is the closing rate, 1,200. That's not it, you have to find the gain also. Remember this pro forma we did. So first in shillings, then the exchange rate, then in dollar. In shillings it is this much, no impairment, so that's why it is same. After that, this you'll be translating using the opening rate, this you'll be using closing rate, and hence there's a difference. That difference is 109, it's a gain. Okay, and this gain will go into other comprehensive income and presented as a item that will be reclassified to profit and loss in future. And also you have to allocate this gain, because it's a fair value. We calculated NCI using a fair value. You have to allocate this between the group and the NCI. So group 80%, NCI 20%. Okay, only the gain 109, not the closing goodwill. Don't take 1,200 there. So that's it. They have only asked for the goodwill. Now let's come to second. Cent acquired 60%. Functional currency is DS. Presentation currency is dollar. Presentation currency does not matter when you are calculating your goodwill. It is the functional currency, that is DS. So you have been given. Now the following information. Before going to the following information, prepare the equity section. Okay. Also, you have to explain why the foreign exchange differences arises in the consolidated financial statements. You have to explain. I will teach you how to explain also, because it's important that you know how to explain as well as the calculation part. Okay, exchange rates are given. Now let us go through this. You purchase L1 for 10,000 on the first day of the accounting period. At the date of the acquisition, the retained earnings 500. Everything is in D if you see. And it exited 1,000, the fair value of their net asset. And this fair value was attributable to a plant with a 5-year remaining 5 years. The reason why they are giving you the remaining 5 years is for you to calculate depreciation on that plant. Okay, if it's a land, you don't have to calculate depreciation. Second, just before the year end, he acquired some goods from a third party at a cost of 800, which is sold to L1. So because he sold to L1, it's an intra-group sale that you have to eliminate on consolidation. Don't forget that. Okay, and it is in dollar. Always check the currency. If it's in dollar, don't change it again. Keep it in dollar. If it is not in dollar, then only you have to change. For a cash at a markup of 50%. This goods still remain in the inventory of L1. Third, Sain lent L1 $1,400 on this date. Okay, you have to use this date's rate only. This liability is recorded at the historic rate within the non-current liabilities. It's an intra-group payable. You have to, it will be removed on consolidation, eliminated. He measures NCI at fair value. Fair value of the NCI is 5,000 D. Impairment was there and it reduced the goodwill by 10% on 30th June 2002. So this time there's an impairment. 1st of July, Sain received a government grant for 4,000. This grant was provided as a contribution towards the cost of training employees over the next 2 years. Sain has reduced its admin expenses by 4,000. Okay. They only told the equity section. Equity section means if you see, you need retained earnings. Then what else? Translation reserve, NCI, net assets as subsidiary in functional currency, goodwill. You need goodwill. because even though you will be wondered how goodwill comes in equity. Remember that exchange gain or loss relating to goodwill. To calculate that exchange gain or loss on goodwill, you have to first calculate goodwill. And exchange differences on retranslation of net asset. Working 6. Provision for unrealized profit. You need it to calculate the foreign exchange gain or loss for net assets and profit. You need this. Government grant. Government grant also you need for your equity section, for your liabilities and all. If it's in the non-current liability, you have to take it out and it will come in the retained earnings. That's why it will affect your retained earnings. Anything affecting your retained earnings will come in the equity section. So there are 8 workings. How to handle this long question? Too many information. Handle it one by one. Okay. This is the discussion of exchange differences. Okay. But if you see the main answer is only this much. But the workings are so much. You have to focus more on the working. Once working is done, you just have to copy paste the answer in your main sheet. This is just the extract. This is what in the main exam also you'll be asked. The extract only. So equity. So equity section means your equity capital. In this case, there's a share premium. You have to see whether it's share premium or not, how to understand and all. We'll see while we are doing it. Retained earnings working 1, translation reserve working 2, NCI working 3. But 8 workings are there because some of it you need for this, some of it you need for this. That's why there are so many workings, but in the main only 1, 2, 3 are referring. And then finally the total equity. So coming to the discussion, let us first finish the discussion part. Okay. Why that exchange differences? Because goodwill. When you translate goodwill, okay, goodwill, opening goodwill at the opening rate, closing goodwill at the closing rate, that's why that difference is coming. That's what it is explained in this paragraph. Okay. Because every year the rate will change, the closing rate. Similarly for the net asset also. Coming to the profit. Okay, third paragraph talks about the profit. This is translated at the average rate, okay? Anything relating to profit and all. But the net asset, this profit increases the net asset, okay? That is translated as the closing date for inclusion in the statement of financial position. That's why, because of that disparity, there is a exchange differences. Now let us go to the answer. So you start with the retained earning. Because for equity, you don't need any. Equity capital, only the parents you are putting. 10,000 if you see here. We take you. You're only taking, you're only taking this. Okay. You don't need any working. But if you see here, you need share premium, you need return earnings, non-current liabilities and current liabilities you don't need. Because it will be eliminated. We'll see that. So you start with the group's retained earnings. Okay. And when you are going, group share of the sub post acquisition profit. So you take 60%. But you have to divide this by 3, the average rate. Don't forget to take the average rate when you are dividing the post acquisition profit. And to find that post acquisition profit, there's a working for. That means changes in net asset is your post acquisition profit, 11,660. You're dividing it by the average rate, 3. And then you're taking 60% to add. Same for the goodwill impairment also. You have to deduct it. The group share of goodwill impairment from the retained earnings. Remember, expenses you have to deduct when you're calculating retained earnings, and income you have to add. So this also you have to deduct. Working 7 is there. Government grant also you have to deduct. Working 8 is there. Hence 3692. Okay. 3692. 92. So I don't have to come back to this table again. Okay, you just have to put the figure. I'm just going to go through the workings. Now let us go to the translation reserve. Translation reserve we cannot do without first calculating goodwill and movement in net assets and profit. So we'll come back to working to later. First we have to finish net asset. So at acquisition, this is in D, nothing you are converting now. D only you are finding. Okay. So equity capital 1000. Reporting date also it will be same. Share premium 500, here also it will be same. Return earnings it will change. This and this. So it increased by 12,000. That increase 500 plus 12,000. That change only you are writing here post acquisition. Let me take you to return earnings. So if you see this return earnings 12,500, this is at the reporting date. Okay, what is given here, this 500 is at the date of acquisition. Okay, in case you don't get confused why and from where we got fair value adjustment, they told that increment is fair value adjustment. So they have given you the net asset as 3,000, right? This is a balancing figure that you have to find out. Let me see the net assets they have given you. They told that carrying amount by 1,000. So they gave you the, usually they give you the net asset figure to find out. Usually the balancing figure goes as a this thing, the fair value. But in this case, they have given you the fair value itself. They give this figure normally, the 3,000, and they tell that the balancing figure is the fair value adjustment. But in this case, they have given you the fair value adjustment. So this fair value adjustments will come at the reporting date also. Don't forget that. Okay, and depreciation will go at the reporting date only, nothing in the acquisition date. So that 1 million divided by 5 years. They have given you the number of years. Hence, here you have to divide minus 200. Because here it is 0, so 0 minus 200. Then we have an exchange loss on the loan. Remember the loan that you have given? It is received by the Albans. There's a loss. That loss also don't forget to take. So initially it was recorded at D. How? They have given 1,400. You have to multiply it back. It was in dollar, but you have to multiply it by the rate at which the loan is given, 3.9. Let's go to the loan. You see, it is in your point number 3, 1,400. Saint Len Albert, 1,400. So Alban is receiving this 1,400. Is a subsidiary. So this 1,400 you are using this rate, 3.9 at that date. Okay, neither opening, no closing, no average, at that rate only. That date, what is the rate? So it is given in dollar. You have to find in D. Remember, exchange loss, because it comes in the net asset calculation, you have to take it as a D. Okay. Now, once you take it in D, you retranslate it using the closing rate. That means this 1,400 you multiply it by 4 now. The closing rate. The loan needs to be changed at the closing rate. So loan comes in the statement of financial positions. So you have to take the closing rate. And this. Now find the difference. This and this. The difference is 140. It's a loss. Because the value of the loan went up. From 5,460 it went to 5,600 in D. That's why it's a loss in D. So because it's a loss, you debit the profit or loss or retained earnings. That means deduct from retained earnings and credit non-current liabilities. Non-current liabilities went up. Hence 140 you have to deduct at the reporting date, not at the date of acquisition. And then this comes. And finally this comes. Post acquisition 11,660. So when you're writing it here, that 11,660 only comes here, which you have to divide by the 3, the average rate, and take the group share only of the profit. So retaining earning is done, translation, NCI. Now let us go to working 5. Okay. Okay, we are left with NCI. So NCI fair value is already given 5,000. You have to take the date, the opening date 2. NCI at post acquisition. Post acquisition is already given. This is given. You just have to take 40% this time. In the retained earnings, we are taking the group share. In the NCI, we are taking the group share of the post acquisition. But post acquisition is in D, so divided by 3 to find in dollar, the average rate. NCI share of goodwill impairment, NCI share of forex on goodwill, NCI share of forex on net assets and goodwill. These 3 things you have to put. You have to deduct. Okay, it is then working 4, 5 and 6. So now let us go to working 5. 4 is over. 5 is goodwill. So goodwill, how do you find out? Remember, goodwill is in D, you have to find out. That's why you are multiplying it 5,000 into 2. Even though the cost is given in terms of dollar. And again at the end you have to convert it to dollar only. Still, you first have to find it in D. So we multiply it back by 2, the opening rate. NCA is already given in D, 5,000. Then you deduct net asset. At acquisition, it is already given 3,000. It's in there in working 4. This 3,000. Okay. This 3,000 will go at the date of acquisition. Then goodwill. They told goodwill will be impaired by 10%. So this 10,800. Now you have to find the exchange gain or loss relating to the translation of goodwill. So goodwill is 12,000. At the date of acquisition you have to take. Don't take the goodwill at the reporting date. This will go here. And the impairment record as it is. Then translate opening goodwill at opening rate, impairment at the average rate, closing goodwill at closing rate, and this is the balance sheet figure you will find out. It's a loss this time because goodwill value went down. Okay. Now this 2,900 you have to take it with among the parent and the NCI. Parent 60%, NCI 40%. There are 2 things that you have to take. One is the impairment loss of goodwill. The other one is the exchange loss on the retranslation. So for the impairment loss, you only have to take this 400. This 400 you have to take in 60 and 40. And for the loss, you have to take 60 and 40 of 2,900. Coming to this. Same for the net asset. You take the acquisition net asset profit for the year. That is the post-acquisition profit, okay, that we have found out. Acquisition net asset opening rate, profit average rate, closing net closing rate, and hence it's a loss. This time, you have to take that loss 60 and 40%. Okay. So hence if you go and check out translation reserve, okay, translation, don't take the impairment thing in here. Okay, translation reserve only deals with the foreign gain and losses. One is related to goodwill, the other one is related to net assets and profit, only the group share. And for NCI, NCI has 3 things: NCI share of forex on goodwill, NCI share of forex on net assets and goodwill, and share of goodwill impairment also. Okay, then we are moving towards working number 7. 7 and 8 is only left. So this is an intra-group sale, it has to be eliminated. Okay, and all of these items remain in the group inventory also. What is it? 50% of 800. Let me check the figure. So if they told, so they have told that here 50% of 800 is the cost, and all of this remain in the inventory. Okay, so 50% of 800 is 400. This has to be eliminated. How do you eliminate? You debit cost of sales or debit retained earnings. You deduct this from retained earnings and credit inventory. Now coming to the government grant. You first have to identify whether it's a capital grant or a revenue grant. This is a revenue grant. That's why it should be recognized in profit or loss on a systematic basis. That means over a 2-year period. You understood as a revenue because they told it will be for the training cost. So it's over 2-year period. It's a revenue grant. It cannot be a capital grant, cannot be for the training cost. Okay, so it should be recognized in profit or loss over the 2 years. You need to divide it by 2. What was the cost? It was 4,000. Divide by 2, 2,000. So this will increase the expenses. And record the balance as a deferred income on the statement of financial position. So you debit the admin expense, therefore return earnings. It will reduce the return earnings and you credit the current liability by 2,000. Okay. It's a current liability. It should not go in the non-current liabilities. So even though you don't, if you see the main answer, it does not include all this working 7, 8 and all, but still you need this working. Why? Because it affects your return earnings, to support your return earnings. Okay, so in the exam also, even though they just ask you that calculate the equity section, so don't think that only I have to calculate share capital, share premium, return earnings, and NCA, that's it. You need this extra working also for return earnings. It affects return earnings. Now let us go to working 3. Because usually examiners are very smart. You think you are smart, but the examiners are smarter than you. That's why the examiner, right, when they set the paper, they set in such a way, even if they're directly not asking you to calculate those things, indirectly you have to calculate those things. Okay, but you have to be smart enough to pick out what are the things you have to calculate and what are the things you should not calculate. The lumps group had sold its entire 100%. This is a disposal, okay, in an overseas subsidiary for process of 50,000. The net asset was 20,000. Carrying amount of goodwill was 10,000. Cumulative balance was 5,000. How do you deal with this cumulative gain? That's what the question asks. That means how do you disposal is accounted. Okay. So main thing, whenever disposal happen, whether overseas subsidiary or not an overseas subsidiary, whether they have lost the control or not. Here they have lost the control. Okay. So that means from that day onwards, you don't consolidate the income and expenses. Until the date of disposal, you have to consolidate. After that, you don't. After that, what should you do? You have to de-recognize the goodwill as well as the net assets and also the NCI. But here they have not given any information regarding NCI. So it's just the goodwill and the net asset. Also, the foreign exchange gain that was previously recognized in OCI will be now reclassified to profit and loss. This is the important thing that you need to highlight, that you need to understand. There was a gain of 525,000. That should be presented in the consolidated statement of profit and loss. Let's see. Proceed was 50,000. This is the pro forma, okay? Net asset is 20, goodwill is 10, deducted from the proceed, and if you see, it will be 20,000. So with that 20,000, this 5,000 comes, because this 5,000 comes from OCI, and this 20,000 is there in the profit and loss itself only. So 20 plus 25, sorry, 20 plus 5 is 25,000. This is how you get the 25,000. Okay, it is the reclassification of foreign gain to P&L, because you're disposing the subsidiary entirely. So you have to reclassify, and you reclassify when you dispose it entirely, not when you have disposed it partially. Okay, gain, this 5,000 gain. So that's it. With this, I have finished group accounting entirely. Also, I have finished the foreign subsidiaries, how to deal with the foreign currency, how to translate, which rate to use, especially relating to net assets, profit, and goodwill. These 3 areas, focus on these 3 areas more. Do more questions from the past papers on this area. Do more questions on group accounting. In fact, because question 130 marks group accounting, right? So that's it. See you in the next video. Next video I'll be covering, I have things left which are current issues, some ratios I need to cover, and also UK gap is there. So these are the few areas that I need to cover, and that's it. And we are almost ready for the SBR to September 2021 exam. So best of luck for the exam and take care.